In this video, we are going to talk about the 5 ways millionaires make money with real estate. So before starting this video, please like this video and subscribe to our channel for future updates. More than 90% of the world's most prosperous people make some kind of real estate investment. And more people become millionaires in the real estate industry than any other. Although there are various ways to make money in this sector, the key is the technique you are using. Which approach works best for each kind of deal? What is the greatest method to make this property generate a profit? You ought to keep asking yourself these queries. Cities in the US are seeing a renaissance due to the robust economy. Businesses are expanding and more jobs are being generated. You're passing up a lot of chances to make money if you don't invest in real estate. Here's the list of 5 ways millionaires make money with real estate. So let's start. Number 5. Making money in real estate by renting out property. This is the tried, true method of becoming wealthy and making money in real estate. You profit from this kind of investment by utilizing long-term hold residential rentals. There will always be a need for housing. Lords and nobles fought over titles that allowed them to extort rent from those using the land for living, farming, and other types of labor. A few enterprising people developed enterprises in drained marshes so they could profit more from the land than if they had just leased it to farmers and ranchers. Since then, a lot has changed, giving people looking to learn how to make money in real estate a variety of possibilities. You could get some land, put up a house, and rent it out. You could locate neglected homes, fix them up, and then rent them out. Someone else bought turnkey houses and rehabbed them before renting them out. It is a buy and hold plan, regardless of how you obtain the property. You can own real estate that is residential, commercial, or industrial. The consistent income flow that rental property offers is one of its main advantages. It is the most advantageous type of real estate ownership for generating a passive income. The disadvantage of this strategy is that you are placing all of your eggs in a small number of baskets. If there are problems with the apartment building you own, tenants will move out and your rental income will drop. Additionally, the expense of repairs will reduce your earnings. Number 4. Interest-based income through investing in mortgage notes. For those looking for passive income, mortgage notes can be a smart real estate investment. You get interest and principal payments each month when you purchase a mortgage note. It provides a consistent income, similar to that from a rental property, but without the requirement for landlord-style upkeep. Due to the absence of local regulations governing real estate licenses or taxes, investing in real estate across the nation is much simpler. The length of the loan is specified in the mortgage note. You are aware of the time frame for loan repayment, which could be 10 to 30 years. By purchasing from a distressed note holder, you might be able to raise the value of the mortgage note. For instance, you might come upon a farm or family home that was sold using owner financing. The person had to manage the loan after selling their house. They might require the funds, either to enable them to purchase a new property or just to obtain cash to support their retirement. In such circumstances, you may offer $80,000 to purchase a $100,000 note. If they agree, you will receive the principal and interest on a loan for $100,000 that you only paid $20,000 for. Number 3. Getting rich by flipping real estate. This is another tried, true method for quickly building wealth through real estate. Real estate investing has a particular subset called fix and flip. An investor purchases a house, makes the necessary improvements, and then sells the house for a profit. There are many reality shows that focus on this kind of real estate investing. This type of real estate investing is, in fact, very risky. If you overestimated the expense of rehabilitation, you can suffer financial loss. You've probably wiped away your real estate profit margins if you invested too much money in the investment property since you didn't comprehend your target market and buyer expectations. The carrying costs of the property are deducted from your profit margin every month the house is on the market, regardless of whether there are issues with the asking price, the real estate agent, the area, or the appearance of the property. Number 2. Making money through real estate investment trusts. You can invest in real estate through real estate investment trusts, REITs, without having to purchase and maintain a physical asset. REITs may invest in real estate, mortgages, or a combination of the two. By purchasing REITs with assets in specific market segments, you can diversify your real estate portfolio. Because REITs are publicly traded, you can purchase and sell shares on the open market, allowing you to diversify your investments and increase the liquidity of your funds. The fact that REITs don't correlate with other kinds of equities is one of their advantages. As a result, rather than the stock market, the real estate market determines the value of REITs. Both publicly traded and non-traded REITs are accessible. The Securities and Exchange Commission advises against non-traded REITs because of their high costs, difficulty in liquidating them, and possibility that they could lose all of their value. REITs that are traded publicly are just as liquid as equities and bonds. REITs stand out because they consistently pay dividends, which fewer and fewer equities do nowadays. Obviously, this also demonstrates how to succeed in real estate and get wealthy. Number 1. Using private lending to make money in real estate. Hard money lenders make loans to people who use the fix and flip business model. In this example, the property investor would acquire a conventional mortgage after they had an appealing property that the bank will now accept as collateral. They might also lend money to those buying properties to restore and then rent out. A higher rate of return is obtained by serving as a bank to property buyers than by leaving money in a bank. Due diligence is required since errors could result in a void lien against the property. Crowdfunding is a choice for those who aren't yet prepared to put a significant amount of money into a single project. You could give someone a loan so they can put money down for their own home or purchase a rental property. The loans are high risk and illiquid in both scenarios. Another problem is that the SEC standards for hard money lending of amounts more than small apply. You might not be able to lend money to real estate investors if you don't fulfill the SEC's requirements for income and net worth, unless you do so in token amounts via a crowdsourcing website. That's it for today. We hope you found our video interesting. If you did, please give it a big thumbs up and share it with others. Also, if you haven't already, please consider subscribing to our channel. Don't forget to turn on the notification bell so you don't miss any of our new uploads. In the end, thanks for watching, and see you next time.